technology's come a long way. Holdings-based analysis like style analytics is quite helpful. We've done it sort of with returns as well, using sort of regression models to isolate those factors, look for the alpha, and determine if a strategy is going to have a specific style footprint or factor footprint, or if it will vary over time, which is another important element to understanding the strategy that we're looking at and evaluating and recommending to clients.
And the technology's been a godsend, right? It really helps us isolate the factors in each of the portfolios that we're looking at, and it helps us determine why is a particular portfolio performing the way it is.
You don't just want to depend on a manager that you're paying an active management fee for to get something that you can get for a matter of basis points in a packaged manner. It's something where as we've evaluated investment managers, that scrutiny has become higher and higher over the last several years, to the point where we've moved on from strategies because there wasn't that alpha present, and it was just a mixture of factors.
Just being able to identify the different factor skews within our portfolios helps us say, okay, well, that's why this fund is doing so well, and that one maybe isn't, right? So it really is eye-opening.
As we're evaluating investment strategies and we're determining if they are above the appropriate hurdle for those strategies that do get recommended to clients, we're looking at a variety of different variables, and one of that is the discipline for which they stick to their investment approach. And factors do play into that. It's a tool that allows us to verify that the manager does what it says it's going to do in a strategy. It's quite helpful for the sort of the style specific managers, because if we see something that's a little odd, it's easier to talk about with them. But for those that tend to have a bit more of a flexibility in their approach, it's informative. It allows us to get a narrative for what to expect in certain different market environments.
It certainly can help us pick benchmarks, right, for particular products. One manager may say that this is the benchmark that they're using, but when we sort of look at some of the factor breakdowns, it's not the right benchmark, right? So that may be, one thing arguably that we could change. The other thing too is, on the consistency side, it can cause us to change our conviction level, right? If we see that drift so from that standpoint, it can have pretty broad ramifications, as far as the inputs to our process.
You think back sort of 15, 20 years ago, nobody thought about active share in sort of the context of how they evaluate their strategy or how they use their footprint to differentiate themselves from the benchmark. Now it's commonplace, and whether or not you like the metric or not, it's part of our conversation. So I think that as we evolve, it's just going to be the same way for factors. As you continue, from an investment manager's perspective, to differentiate your strategy from the benchmark, from other strategies, and to show that there's true alpha there, not just a mixture of things that you can get cheaply, it's going to become more and more important.
We try to tease out how good is this particular manager, he or she, at generating alpha, right? Or are they just making factor bets, right? And there's not an easy way to sort of tease that out, but we try based on some of the tools that we have. We try to see, does a manager actually add value outside of just the factor skew? And is it repeatable? Members of the investment committee often ask questions about the sort of the factor skews. It's identification, right? A lot of times, right? And trying to figure out what drives the performance and to explain performance.